So both the Bank of Canada and the U.S. Federal Reserve delivered cuts today of 25 basis points. Beyond the move, what do these decisions tell us about the health of the economy, both here and in the U.S.? Jeremy Kronick joins us now. He's Vice President, Economic Analysis Strategy at CD Howe. Thanks for joining us today.
Thanks for having me.
Okay, let's talk about a couple of things. The cracks in the economy here in Canada, you have mentioned, are visible. I'm wondering if you think a cut as the one we saw today are going to help at all to deal with those cracks.
Well, I mean, I think so. The idea behind the Bank of Canada cutting is to stimulate growth through demand, right? And so as interest rates fall, there's more demand for credit, but there's also folks that have mortgages and variable rate mortgages. Now they're, to the extent that their mortgage payments are a bit less, that might stimulate consumption. So the idea is to stimulate aggregate demand with these rate cuts. How successful that will be, I think, is unclear. I mean, the numbers on unemployment were pretty weak for July and August. The second quarter GDP was pretty weak. So, if more is needed, I think, is the big question. But this 25 basis point cut will certainly start to help us in that direction.
It's not going to hurt. That being said, as you mentioned, a lot of people have the same concerns they did at the start of the year. They might not be talking about it as much, but it's tariffs. And there is no solidified trade agreement that exists that Donald Trump doesn't seem to be able to rip up in parts. So if you're going to get a cut and it's 25 basis points, is it, do you think, going to move people beyond the tariff concerns still remaining?
Well, I mean, it's a great point, and I think that actually speaks to the problem with rate cuts in general, is that they're meant to stimulate demand. On the supply side, what you're getting with these tariffs and all the uncertainty around these tariffs is really weak business investment data. Now, this weakness we've seen for a while, but it has really picked up of late. We saw exports fall by 30% in that second quarter, meaning that the resilience we were seeing was basically just front running of those tariffs. So as the productive capacity in the Canadian economy declines, or if the growth slows, you might actually end up with your sort of stagflation, the dreaded stagflation scenario, where you're getting weak growth, but you're also still getting a little bit of inflation, right? Because demand's falling, or demand, growth is slowing, but so is the supply side, right? And so you end up with this inflation scenario with a weak economy, and that is really kind of the danger of all this. And so you might need further rate cuts to provide that additional stimulus.
Let's talk about job losses and where they have been. We know that the tariff affected industries are clear for sort of the automotives, steel, aluminum, copper, those sectors in particular. But you are saying you're seeing it actually wider than that. And what does that indicate to you?
Yeah, so right. So the data indicates that the employment losses now are not just in those tariff-sensitive sectors. They're concentrated there, but they're not just in there. It is spreading to other parts of the economy, and that indicates that you're getting this kind of widespread contraction to the economy. And so when it was just targeted, or when it was just narrow sectors, that's when fiscal policy can come in and it can target its support where needed. But monetary policy is a very blunt tool. And so this weakness that you're seeing beyond just those sort of tariff-affected sectors, that's really where you can get that help from monetary policy, right? It's helping. It's worse for the economy, but that's where monetary policy can be helpful.
Fiscal policy has been announced. We're not going to see the results of that in the near future, right? We're getting a budget in November. Although some has been announced, there's not really money flowing in big amounts just yet. So that is to come. Do you think that factors in yet to the Bank of Canada's decision-making process, or do they wait for the results of that money to flow before they can sort of make any decision around it?
I think it's a little bit of both. I mean, monetary policy works with a lag too, and so when you're moving the overnight rate today, you have to be looking at where the economy is going in 6 to 8 quarters, right, in the next 6 to 8 quarters. And so, fiscal policy is a big part of that. So they certainly will, anticipate what fiscal policy is going to do, but we don't know for sure what they're going to do. We don't know what the budget's actually going to say, where those dollars are going to be spent. And so it's still unclear how that affects inflation. And so I think the bank has to take what they know, the facts that they know on the ground right now, and adjust to that reality. And then they may have to see how fiscal policy plays out in terms of determining where future rate movements go.
What's your feeling on recession and whether that is avoidable for Canada?
Well, so the second quarter GDP was very negative, 0.4%, 1.6% annualized. if you took the first quarter and you looked at those two, you wouldn't have sort of your technical definition for a recession, or really anyone's definition. But the early data for Q3, so StatsCan has their flash estimates for July. That was positive, but this employment data we have is for July and for August. So we're into 2 months of Q3 there, and it looks pretty bad. So it's hard for me to imagine that the rest of the months of GDP in Q3 are going to be positive, which means you're going to get your 2 quarters of negative growth that some people use as kind of that definition of a recession. So when you combine those 2 quarters of negative growth and falling employment and the widespread nature of that falling employment that we talked about, you're getting into to sort of the definition of a recession, in my view.
The thing that I found really interesting from Tiff Macklem talking about today was the fact that all of these business owners are now trying to do the pivot, right? And that pivot takes time. Where am I going to find a new market that's going to somewhat replace my customers in the U.S. because I can't afford that export duty? And supply chains also have to be rerouted. That could take a very long time. And do you think that could be a negative drag on the economy for like the next year, 18 months?
Yeah, so certainly the adjustment process to the tariff world, to the U.S. pulling back from global trade, I mean, that process will take time. There's no way around it. And that's why we're working very hard to look at other countries and trade deals with other countries and what we can do to support, in the interim, domestic policy. So internal trade barriers has been a big discussion because in part that's a way of opening up markets, domestically to deal with the fact that we have these troubles internationally. But that process will take time. It will act as a drag, and that's where I think you're going to see some fiscal policies, some structural policies necessary to boost domestic policy or to boost the domestic economy.
Jeremy, good to have you in. Thanks for joining us. Jeremy Kronick is Vice President, Economic Analysis Strategy at the CD Howe Institute.